Good morning. This is Business Live with me, Ian King. Now, the government's plans for cleaner energy have been dealt a huge blow this morning. The latest renewable energy auction failed to attract a single bid for new offshore wind. The chief executive of Scottish Power, Keith Anderson, called it a multi-billion-pound lost opportunity. I shall be speaking to him fairly shortly. But first, let's get some background from our business correspondent, Paul Kelso. Paul, this is quite complicated. Talk us through it.
Yeah, we've been reporting since yesterday, Ian, that this auction for offshore wind particularly was going to fail, partly because the government had set the price too high. The way these auctions work is they set a reference price. Suppliers bid below that price if the auction's working until you get a consensus price that's lower, and that sets the maximum price for the megawatt hour of electricity that the supplier can charge and that the consumer can pay. It's called a contract for difference. If the price of electricity is below the price that's been agreed, the Treasury makes up the difference to the supplier. But if it's higher, as it has been pretty much since the invasion of Ukraine, the suppliers pay money back to the Treasury. It's worked very well in the last decade, allowing the UK to build huge offshore wind capacity, 14 gigawatts of capacity. The target, though, is to treble that by 2030, which makes this auction round, every auction round for the next couple of years, really important. But none of the big players, no players at all, bid for offshore wind because it simply doesn't stack up in the new economic environment they face, where there's huge inflation in the supply chain, concrete and steel up to 40% more expensive, and the cost of financing has gone up. I'm told by industry sources that officials and ministers were told repeatedly this price would not attract bids. So it has proved. Should be said that onshore wind and solar have attracted bids, but they've come in just under that reference price. It indicates that the inflationary pressures are being felt right across the renewable sector, and there's no fat in energy companies' budgets or indeed appetite for risk. It leaves the government with a real challenge if they're going to meet that 2030 target. Frankly, it's going to have to double the amount it's ever got in a single year in the next two auctions. It looks pretty unlikely. And you have to address the fact that the rising costs mean that everyone, government, companies and ultimately consumers, are probably going to have to pay more to deliver the net zero targets. We should say the energy those renewable sources produce is still cheaper.
OK, thanks, Paul. Well, joining me now is Keith Anderson. He's Chief Executive of Scottish Power. Keith, good to see you this morning. The Shadow Energy Secretary, Ed Miliband, says this is an energy security disaster. Is that over-egging it?
Look, I'd say this is a misstep. It's a big opportunity that's been missed. And I think the important thing ultimately is that the 5 gigawatts of projects that could have gone through this auction would have taken about £1 billion off the cost of energy for customers in the UK. And that's the opportunity we've pushed back in time. On the upside, we have another auction coming up next year. So there's a real opportunity for the government to get the industry back up and running and get us back on track to hit those all-important targets.
Now, the government capped the price at which you could bid at £44 per megawatt hour. What sort of price would you have needed to be persuaded to participate?
Well, I think it's difficult to answer the question, what should the price be? I think what's happened is, the market has moved very quickly. World demand for offshore wind has increased significantly. World demand for turbines, for cables, for substations has gone up significantly. Commodity prices have moved, and they're still moving. So the government needs to make sure not only that they set the correct price, but they allow themselves flexibility to move the price and adjust the price the closer we get to the auction date. And without that flexibility and agility, you constantly run the risk that you misread the market and you misread where investors are.
Why do you think the government was so reluctant to change the price?
Look, I think there's always been, from the government's point of view, a real desire to make sure they're getting the most efficient price constantly out of the auction mechanism. And that's understandable because it goes through to consumers' bills. But I think that the government misread how quickly the market was moving and how much prices were changing and how significantly they were changing. And I think they locked themselves into a mechanism and a process that didn't give them the flexibility to move. So, we've had a mistake. We've got an opportunity to fix it. The critical thing now is that AR6, the next auction, has to be big enough and bold enough to get the targets back on track, to get investors back on track, to get the supply chain back on track, and for us to drive down the price of energy for customers.
Is there anything to stop the government from reviving this auction with a slightly higher price cap?
No, I think we need to look at auction round 6. That's due to take place in the spring, or start in the spring of next year. That's where we all need to focus and work together now. We need to make sure we make that auction a success. As your correspondent said earlier, we need to make sure the auction is big enough, is bold enough. We need to get the 5 gigawatts of projects that missed this auction into AR6, along with a whole lot of other projects as well. So this needs to be a big, bold shift and a big, bold move from the government. That's what will get confidence back in the market. That's what will get the supply chain investing in more manufacturing and production. It will create jobs, and it will give this country safe, secure energy at the lowest possible price. Although prices have gone up, this is still by far and away the cheapest way of delivering future energy for this country, and the cheapest way of getting customers' bills down.
Does this mean, Keith, that in the meantime, obviously there's going to be a shortfall in the amount of wind power generation that the government would like to see? Does this mean more oil and gas taking up the slack in the short term?
So right now, this is the problem, which is without more renewables coming on the system, we remain reliant on fossil fuels and on gas. It exposes us to the volatility we've seen in those prices, and that price then feeding through to customers. It exposes us to issues about energy security. The faster we invest in renewables, and the more we invest in renewables, the more secure the system becomes, the less volatile the system becomes, and the cheaper the system becomes. This is the best answer for everything. It's the best answer for security, the best answer for the environment, and the best answer for price.
Keith, we have to leave it there. It's good to see you this morning. Thanks very much indeed.
Yeah, thank you.
Some other news stories for you now. And the house builder Berkeley Group this morning launched an attack on the government's planning rules as it revealed it's not bought any land during the last 4 months. The UK's second largest house builder by stock market value said the complexity and protracted nature of the current planning system and lack of clarity surrounding certain regulatory changes affecting our sector at a time of considerable uncertainty for the UK economy with persistent high inflation and interest rates continues to deter investment into brownfield regeneration and the wider house building sector. Well, the comments came as Berkeley Group reported that home reservations during the 4 months to the end of August were down 35% on the same period last year. It said this reflected the elevated macroeconomic and political volatility, but it said pricing remains resilient. The music investment vehicle Roundhill Music Royalty Fund has agreed a takeover, valuing it at $468.8 million. The buyer is a rival investor called Alchemy Copyrights. Roundhill Music was founded in 2010 to buy rights to songs whose royalties could then be exploited commercially. It owns 51 catalogues with a collection of more than 150,000 songs, including She Loves You by the Beatles, You Ain't Seen Nothing Yet by Bachman Turner Overdrive, and Protection by Massive Attack. UK competition watchdog said today that the Civil Aviation Authority had made some errors in determining the lower price cap that Heathrow Airport should charge airlines. But the Competition and Markets Authority said it still provisionally backs the CAA's decisions over how much Heathrow can charge airlines between 2024 and 2026. The CAA said the cap on Heathrow's average charge per passenger must be cut from £31.57 for 2023 and last year to £25.43 over the next 3 years. That ruling angered both sides, with both Heathrow and 3 airlines, British Airways, Delta Airlines and Virgin Atlantic, appealing against the CAA's decision. Now, a package of reforms and new initiatives across insurance, pensions and sustainable finance could boost UK GDP by £225 billion. That's according to a report just published by the City of London Corporation and the consultants Oliver Wyman. Among its recommendations are for a Financial and Professional Services Council to advise government on how to drive economic growth. Well, joining me now is Chris Hayward. He's chairman of the Policy Committee at the City of London Corporation. Chris, good to see you this morning.
Good morning, Ian.
What motivated you to produce this report?
Well, we think that the biggest challenge for any political party, no matter who wins the next general election, will be how you take the stagnant economy that we've had the past 15, 16 years and build economic growth. Economic growth is the only way forward. And so we've gone to over 300 of the top financial and professional services firms in the United Kingdom to actually put together a package of measures which includes some of the government's current initiatives, I might say, which can total, if they're implemented by politicians, create £225 billion of investment growth in the United Kingdom economy between now and 2030. Because one of the great challenges that I find as I go around the world talking about financial services is that our competitors, particularly in Asia, they have very, very clear strategies, overarching strategies. And what we want is the United Kingdom to have the same thing.
One of the lines in the report that jumped out at me, you wanted a culture change in the pensions industry. What do you mean by that?
Well, we think that the opportunity that, for example, the Mansion House reforms offers of taking 5% of DC pensions and investing them in unlisted businesses to support high-growth British businesses is a great opportunity to ensure that they then subsequently list in this country rather than overseas. And not just the DC pensions, but also the LGPS, the local government pension scheme as well. So this is about getting good returns for savers, but at the same time investing in British business.
Now, the idea of a Financial and Professional Services Council is an interesting one. Aren't a lot of cynical people just going to say, this is just the city trying to sort of cosy up to government for its own ends?
Well, I'm sure some cynics will say that, Ian, but my own personal view is that why we've proposed this is it brings together the public and the private sectors. And we think to really implement a consistent strategy over that 10-year period, you need both. Businesses tell us that what they hate are the constant changes in strategies and policies. So if you've got a body which we would propose and suggest is chaired by the Chancellor, but has equal private sector representation on it, it will have the opportunity to ensure that the strategy actually gets driven.
How do you stop it from just being a talking shop? I mean, the government's had business councils to varying degrees of success over the years, hasn't it?
It has, but it hasn't had a business council for financial and professional services. I think the answer to that is by following the roadmap that we are setting out and by ensuring them, we would suggest this meets quarterly, that actually those targets are being met on a quarterly basis for the implementation of the plan.
Now, another of your recommendations is for digital data verification across a range of products and services. What sort of things have you got in mind there?
Well, we think that data and the opportunity to be a world leader in data and digital and the digital economy is absolutely crucial. So the one-stop verification system, which could make banking so much easier, really driving initiatives that actually make it easier for people to bank, to do financial services, is a real mega way forward and will add not only jobs, it will add growth to the economy.
All right, Chris, we've got to leave it there. Thanks for coming in today.
Thanks, Ian, very much.
Bit of breaking news to bring you that's just reached us in the last few moments. Network Rail has been fined £6.7 million over health and safety failings over a rail crash that claimed 3 lives near Stonehaven in Aberdeenshire in 2020. The fine would have been £10 million, but it was reduced by a third in recognition of Network Rail's guilty plea. Well, last night's sell-off on Wall Street, which was driven by another fall in Apple shares that's wiped $200 billion from the company's stock market value over the last 2 days, was followed by declines across the Asia-Pacific region overnight. As you can see, Hong Kong, the only major index there not to finish in negative territory. Well, in Europe, stocks are also heading into the weekend on a downbeat note. You can see all the main indices in the red there. It's the longest-running losing stock for European stocks since November 2016. Chip stocks are among the major fallers this morning. That is amid ongoing concerns over China's ban on Apple phones. For example, ASML, one of the big Dutch chip companies, is off 2% right now in Amsterdam. Well, here in London, the FTSE 100 is very slightly low. It's a tenth of 1% down. Pretty broad-based sell-off there, but no real fireworks. The biggest percentage faller is the engineer Melrose. That was actually the biggest percentage gainer yesterday. Melrose off some 4% right now. There are some gainers to mention, and JD Sports is the leader right now, up 3%. It's had a push from one of the brokers today, while the insurer Beazley, you remember the chief executive was on the programme this time yesterday, well, that's rallied nearly 1.5% after yesterday's sell-off. Outside the FTSE 100, The music rights specialist Hypnosis is up 8%, another company whose CEO's been on this programme in the recent past. That's, of course, on the back of the takeover bid for its peer Roundhill Music, while the investment firm Peters Hill Partners is off some 12% after it issued a profits warning. On the foreign exchange markets, again, the big story there is one of dollar strength. The greenback is in line for its 8th consecutive weekly gain, which would be its best winning run since 2014. Sterling, though, more or less unchanged against both the dollar and the euro this morning. Oil price continues to grind higher, close to a 10-month high again. A barrel of Brent crude will currently set you back $90.39 a barrel. That's up 0.5% on the session. Well, joining me now is Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdown. Sophie, good to see you this morning. Apple has had a real shellacking, hasn't it? I mean, this is an astonishing number, 200 billion off its market cap in just 2 days.
Hi, Ian. Yes, absolutely. This is clearly the really big one, looking at the kind of the back end of this week. So the shares are off about 3% today, but as you say, over a 2-day basis, we are looking at about $200 billion that have been wiped off the share price. And really what we're seeing is a great deal of anxiety over the fact that there are rumblings of China banning the use of iPhones, particularly looking at kind of state staff as well. So this is clearly problematic. I wouldn't say at the moment that this particular development is kind of a derailment of Apple's success. Absolutely not. Greater China accounts for about $16 billion of the $82 billion total of quarterly sales. So there's lots of other growth potential in other areas. The thing that the market is really worried about right now is whether or not we're seeing an acceleration of China's efforts to kind of step away from reliance on Western tech and products more broadly. So that's where a lot of the anxiety is coming from. But as you say, enormous moves over the last couple of days.
Now, in terms of trading updates today, Barclay Group is probably the showstopper. I mean, that was quite a revelation that it's not been buying land for 4 months.
Yes, huge revelation. And, a lot of the house builders are in tricky spots. So as much as I know that, Barclay, they are laying the blame at saying, the red tape is too much and things like that, there is another side to that coin, and that is protecting cash, keeping it within the business, because they've also spoken today about concerns over the macroeconomic environment. You were mentioning earlier, private sales rates are down 35%. That's not small fry. Part of that, obviously, we are starting from quite a high base, which obviously makes comparisons quite difficult. But the overarching theme coming from all the builders, despite new build pricing holding up quite well, is that there's a real lack of urgency in the housing market right now. And so what Barclay Group are doing is, as much as it makes kind of operational sense, while constraints are so strong on the buying of land, it's also very much about them trying to gatekeep some cash and keep it in the business, which helps them prepare for bumps in the road that are coming through.
OK, Sophie, we have to leave it there, I'm afraid. Good to see you this morning. Thank you. Still to come here on Business Live, the rise of the digital bank. I'll be speaking next with the CEO of Zopa as it secures new funding.
The deadliest warrior in the world.
The Gurkha warrior is about the British military, their heroism and their untold history. Around 70 years ago's history, when the British troops they deployed to the Malaysia called Malay Emergency. So this is the story about the film is about. Their untold history and their friends and families, their sacrifice, their wife, how was it like? So this is about the film. We were not. First time we are telling our story through the cinema. Of course, there are many books been written by author, as in like a British author, and then also like the Nepalese author, or like the other but first time as an authentic director himself. he's the most respected, and he's the most right person to for the film to bring out the story about the Gurkhas, and we wanna let many other people know, or like let them see our history, and we wanna bring it. That's the plan.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
Welcome back. The digital lender Zopa Bank has raised £75 million to fund its expansion ahead of an expected stock market flotation. Zopa, which only became a bank in 2020, says it now has more than 1 million customers. Well, joining me now to talk about this is Jaidev Janardana, the Chief Executive of Zopa Bank. Good to see you this morning. Did you raise everything that you were looking to raise in this funding round?
We did. We had existing investors actually supporting the round, and we got what we wanted.
And this was your second funding round this year. No mean feat in this climate.
Yes, so we've had very strong business performance. If you look at the economic environment, it's challenging, and customers really want to have better returns on their savings or responsibly and fairly priced credit. And that's exactly our proposition, which we deliver digitally. And as such, we have seen thus strong demand and great financial performance, which has enabled investors to have confidence in us and thus raise the money.
So you're talking about expansion in the statement. Specifically, what does that mean? How will you be deploying this capital?
So we as a business are profitable, so we generate capital. But as the bank grows, it requires more regulatory capital, and this is really about that. In the long term, we are really looking to build UK's best bank. We serve 1 million customers, as you said. We want to make that 5 million. And that growth will both come from the existing products, but also new products that we launch. And this funding just helps kind of grow that balance sheet.
So you've gone past 1 million customers now. Which are the products and services where you're seeing most demand?
Actually, we are seeing demand across the board. So on this borrowing side, personal loans, we're seeing strong demand, credit cards, as well as we recently launched Buy Now, Pay Later, more focused on some bigger ticket items, and that's seeing demand. On savings, we are one of the few banks that have actually religiously passed on the increasing base rates to our savers, and thus we are seeing demand there as well. So it has been across the board.
How difficult for you is it, though, in remaining competitive in savings when you've got national savings and investments really going with some very, very punchy interest rates?
I think that's very good for savers, that after a long time they are able to get some returns on it. And we welcome some of those things, because I think the bigger issue here is the fact that with the high street banks, there are billions of pounds earning nothing. So I think things like the NSNI actually really help increase customer awareness, which actually I think helps us. We have innovative solutions which produce not just give good value, but also a great digital experience. And that's how we are able to compete with some of these other players as well.
You mentioned some of the loan products you've got there. You're doing personal loans, you do car loans, you do credit cards, not mortgages yet. Not mortgages yet.
Right. I think when we look at the mortgage market, I think it's an interesting market, but it's also very heavily competed. And that's where some of the big banks really focus on. So I think it's in our roadmap, but probably later. What sort of timescale? Mortgages probably more in the 3 to 5 year product time scale. We will have something else. We'll have other products launching before that.
Right.
Yeah.
And what sort of delinquency rates are you seeing right now in terms of unsecured loans?
I think we are seeing very strong credit performance. So I think the UK consumer has been more resilient than we expected and feared. Part of it is actually the consumer base we serve. They have built up a good savings buffer through the pandemic. Part of it is actually shifting away from some of the discretionary spending. So we are seeing less spending on buying cars, home improvements, and instead consumers focusing to consolidate debt and lower the cost of debt. And that has meant that the credit performance actually has been improving this year as opposed to worsening as we had expected.
All right, Jaidev, there's lots more I wanted to ask you, but we're out of time. We'll have to do it another day. Good.
Thank you. Thank you for having me back.
That's it for me right now. Just before I go, though, I want to show you some pictures from Hyde Park. We're about to have a 41 gun salute across the country. That is to mark the first anniversary of the passing of Her late Majesty Queen Elizabeth II. So do stay tuned for that. That will be coming up after this short break. I'm back at 4:30 this afternoon for our afternoon edition with all the latest on the market close. Wonder if it's going to be another big sell-off in Apple shares today. We'll find out later on. Do join me for that and stay with us to watch that 41 gun salute.